Now, here's some guidelines. You want to look at when you're looking at selling options, you want to only place trades that have been, have calculated risk and a high probability of working out for you. So you don't want to be selling options in front of a major area that could, be a resistance point that could be on the verge of breaking or support. So you want to be very, very calculated and strategic as far as where you place your option selling type setups. Never sell naked options until you're an advanced trader or you feel very, very comfortable with what you're doing and you understand the risk that's involved. And you want to have a larger capital account. You're going to have a portfolio margin account, and you're going to have to be approved by your broker to sell naked options. So I don't ever really advise that, and that's why we're going to use these credit spreads, because you're not going to be selling any options naked. Now, if you're really good and again experienced, then it's something that you can add to your trading plan. Now, we want to also use the mathematical models and statistics to determine which options to sell and when. So this is going to be a real key element to this type of trading, using your statistics and your option model, to help you find those points where you think you're comfortable or the probabilities are good to sell options. So by using statistics and probabilities, then the trading becomes more systematic as well, and it's going to help you to kind of get your emotions out of your trading. So that's what you need to work on. That's what I'm constantly working on, keeping your emotions out of your trading. Now, always know before placing a trade, what is the maximum gain, what is the maximum loss, and where are your adjustment points for that trade if everything goes wrong or goes perfect. So you want to have everything kind of planned out before the trade is even placed. So you want to look first to selling options or option credit spreads also when the implied volatility is high. So you're going to look at implied volatility 30% or higher is preferred, because if you don't have enough, the implied volatility is not high enough, you can't get enough premium to make that option strategy or the risk reward work out and be worth your while to take that risk. Now, also always set up adjustment and hedging points. I call that the kind of line in the sand. So if that trade goes against you, there's an established point for defending the trade and adapting it to the new market conditions or trends that could change in a trade. So always have that adjustment point. What is that line in the sand? Is it a certain Fibonacci level that gets hit or closed above or below? Is it a moving average? Have these points where you can then take action. You want to keep your trading contracts down to minimum size, until you get more comfortable with it. And sizing your positions based on risk acceptance is also something that you should look at. So look at your capital at risk, what percent you want to put at risk, and then adjust your size accordingly to that kind of formula. So the goal is to increase your account balance by selling premium or theta and keeping your losses to a very, very minimum. So by doing this, we're going to look at just kind of high probability trade setups and then adjusting those trades before they get into trouble. So you can kind of think of, if you're doing credit spreads and doing that selling option strategies for income or profit versus just strictly hedging, you want to look at it kind of as a campaign, because you might get 9 out of 10 credit spreads could be perfect, and you're making a nice little income, but then you might get that 10th one that just blows up your account. So you want to be aware that these are high probability setups based on statistics, but you're going to see that the risk reward ratios are what we call a negative. So you're going to be, a lot of these type of credit spreads, you're going to be risking more than you make. So you want to be very, very certain as to where you draw a line for adjustment, stop loss, etc. And again, it's like a campaign. So if you do, take off a spread, we want to look at maybe rolling out, doing some other additional credit spreads to it to bring in additional premium to offset that potential loss.